Good evening and welcome to all in today's webinar on recent amendments in taxation of firm, in particular Section 45, Subsection 4 and 9B. Today, we have the distinguished presence of CA Sanjay Agarwal sir, Chairman of Direct Taxes Committee. Along with this, we have CA Jayesh Thakkar sir, who will be moderating today's webinar and has overall experience of more than 14 years and has advised several multinational and domestic clients on indirect taxes and allied law matters. The speaker for today's webinar is C.A. Rajan Vora sir, who has an extensive experience in representing tax litigation matters before the Income Tax Appellate Tribunal, an authority for advanced ruling. His experience includes more than 4 decades in litigation, tax advisory, and corporate tax advisory services with specialization in transfer pricing and international tax issues. He was also named consecutively for more than 12 times amongst top tax dispute advisors in India by Euromoney's International Tax Review magazine, published from London in 2022. He has presented many papers and has been a regular panel speaker at various seminars and symposiums in India and abroad. With this, I request CA Sanjay Agarwal sir, Chairman of Direct Taxes Committee, for his welcome address. So over to you, sir.
Namaskar, good evening to everyone. So I welcome in this webinar today on the topic which we are going to cover under Section 45(4) and 9B and the recent development in this particular sections. So friends, we have with us C.A. Rajan Vora ji, and as Prachi has already given you a little brief of sir, but the list is endless. And I'm very much sure that his deliberation on this topic will not only solve various queries which we have, but we will also get insight on these sections. We are also confident that we will not do any wrong thing after the end of this webinar whenever there is any use of Section 45 or and 9B way in the new era. Today, friends, let me tell you, those who are old practitioners like us, they were having certain things in their already mindset for which we were doing the various taxation computations and tax planning. But now it is completely changed. And I'm confident that the faculty will not only cover the bare provision, but also will also take into the conversion of the capital asset or vice versa, as well as the how the taxation will happen, the way it will go, and what precaution we should take. Today also we have Jayesh Bhai as one of the moderator for the program, and he will be taking up the queries in the end which are there on the dashboard which will be given to him. And we'll try to see this viewer that last 15 minutes at least we keep that for the queries. So sir, I would be requesting to Rajan sir that we need to see to this that if we are not in a position to complete by 7:45, then I would request you to continue for another 15 minutes so that the queries of the queries can be taken. Sir, let me tell you that at Direct Tax Committee, this year we are the merged committee of the international tax as well as the domestic tax. So today we are in the issue having only one Direct Tax Committee, which used to be there before I joined the council in the last my stint in 2008-9. So the committee is now looking after the entire your portfolio, what you are handling, not only the direct tax practice, double AR also, transfer pricing also, and everything. So we are now responsible. At the direct tax committee, friends, we are going to organize on 14th and 15th July a tax clinic for the common taxpayer all over India, and we are trying to organize it at 168 location in the ICI Bhavans. And for this, we have been associated by the income tax department on the publicity department of the income tax department has given us the association for that. So we are organizing, and our own chartered accountant will try to solve the problems of the taxpayers. They will try to tell them their rights, liabilities, duties, everything in 2 days on 14th and 15th. Beside this, friends, we are giving regular inputs for OECD also. We are also interacting with the department. And very recently, I have been asked to connect with the board for the purpose of the utility of the tax audit. So we are trying to pursue them that the tax audit utility should be brought as soon as possible. Friends, your committee is also working hard on giving you a technical guide on the audit of charitable trusts and institutions. We are also revising, as we have done in the last year in the direct tax committee, the tax audit guidance note, which we are going to revise for this year. And I'm confident that it will come in the month of August, in the August council meeting. So with this background, I hand over the proceeding to Rajan sir for the further deliberation. I'm here. Will be in the connection. In any case, any difficulty is there, so that Judge Bhai will look into. I would also just mention that my Vice Chairman Piyush Chacharji is supposed to come in the beginning also, but as they have not slept whole of the night yesterday because the result the issued and the president wanted that the interim final result be declared together on 57th day, and this is happening for the first time in the entire history of the ICI. So he will be joining late, I suppose, in the end of the webinar. Thank you very much. Do continue to view us, like us, criticize us, or give the comments on our program. Thank you very much. Rajan sir, you may continue.
Thank you, Sanjay ji. It gives me great pleasure to be here for the one more webinar organized by the Direct Tax Committee. As you rightly said, this was earlier Direct Tax Committee, then two committees become separate, and again back in we are now with the DTC, which has a large, and I have privilege of being associated with the institute for more than 45 years for various programs, various booklets, and also with the Direct Tax Committee for almost 22 years. I was part of the nominated member for at least few years for Direct Tax Committee and then International Tax Committee. So I have been very regularly associated and also regularly in touch with the various programs or attending various programs, participating in various programs. So as you rightly said, it is a commendable job is being done by the Direct Tax Committee and International Tax Committee for sharing our knowledge, which we have or what we have from the compiled from everywhere to our profession or professional colleagues. And that gives a great satisfaction to the professionals to see that they are continuously kept update with the latest developments. So that is I think the background, and I'm very happy. I also welcome Jayesh, Prachi, Mukta, and Piyush when he comes. I'll again welcome him because I know Piyush only through his father, because we had worked very closely with SP Shahar Saab. So since then we know each other. and he used to accompany his father to travel. That's how we knew each other well. Recently, when he met me, so he said, he immediately connected Mukta and said, you have not come in our term for any, last year I had come, but this year you have not come. So you should take up one session. So immediately we agreed. So, and he says it is in the webinar form. I said, very happy. So at least I'm able to reach out to the large number of participants. So at least because when it is physical, it has a limitation of number of participants. But when it is a large number of webinar, it is there. But at the same time, disadvantage is that we are not able to meet or anybody get in touch with each other. So that's a disadvantage. So there are plus minuses for both. So I think we'll have to balance between the two. But as Sanjay ji said, it is better to go through the webinar so that we are able to reach at the same time all over India and be connected with everybody. I think that's a great achievement. The technology has taken us to reach to everybody. At the click of the button, we are able to reach everybody. I think that's a great power of our activities. I think that's a great. When Piyush asked me about what is the topic we would like to consider, I was debating whether to take international tax or transfer pricing or corporate tax issue. Then I decided to select the corporate tax issue for two reasons. One is day to day, we don't really get into those topics because in the more practice, we handle more relating to international tax or transfer pricing. So he said, let me also attempt to learn, understand, and share my thoughts on these topics with the participants so that at least I can learn from them, from queries what they will share with us. I will be able to learn and at least make my knowledge clear on this topic, because which I am also, as I said, also learning on this topic, trying to understand this topic. I just went through, I was going through the archive. I found that the first time I had given to the institute the lecture or public presentation on taxation of firms, and that was somewhere around 1978. So then I realized that so many years have passed, and again we are back in the action, but only with the new form of taxation provisions now, which is now completely overhauled. And now we are seeing two new provisions, that is called 45.4 and 9B. As Sanjay rightly said, we need to understand the intricacies of this provision. We also have to see how this is going to affect, and this is not the conventional provisions which all of us are, at least our age people are familiar with. That is not the provision. So this is a new provision. The complexities, litigation, which all happen later on, because these are the initial years when we are really trying to understand. So this is always good to understand the provisions clearly. Sanjay, are you able to hear me clearly?
Yeah, absolutely clear. I wanted to mention that Piyush Bhai has come. He has joined. Piyush Bhai, are you there? He just came and he thought that it is in the middle of this. Sir, you need to do it on the...
Sanjay, I'm not able to hear it.
Let me see. Yeah, hide the presenter view. Yes. Yes, sir.
Can you hear me now, Sanjay ji?
Yes, I'm hearing you, sir.
I'm not able to hear you.
Control room, please check.
Prachi, can you hear me?
Yes, sir. PPT is now fine. The view is fine.
No, but he's not getting me. Prachi, are you getting me?
Yes, sir. You are audible.
Sir, I am audible.
Sorry, friends, there is some connective technology issue.
Sir, you continue, sir. Prachi, you sir. I think there is something with me in my...
No, sir. You are audible to us also.
So you telephone to him, he is fully audible.
Yes.
Right in the chat box also.
I've mentioned in the chat box.
He's picking the phone. You are audible, sir.
Hello,
Yes, sir, you are audible.
Prachi,
We
can
may
you hear me?
continue.
What you did?
Uh,
Prachi,
yes, sir, you are audible.
can you hear me?
Yes.
Yeah. Initial remarks, could anyone hear, or you could hear initial remarks, Prachi?
Yes, yes.
So only recent, now only it was not audible, no?
It is fine now. We can continue.
Okay, okay. But initial remarks were clear?
Yes.
Okay, sorry, friends.
Absolutely clear. Absolutely clear. We are close to 1,300 participants as of now, sir. You
Okay, very
continue,
good.
sir.
Correct. Thank you, sir. Thank you. Thank you, Prachi. I think there are some technology problems. So we are too old people for handling the technology. Youngsters are able to help us, but we are not able to do that. Friends, I was mentioning the first topic I had considered in my professional career was for the Institute on the taxation of firms, that too in 1978. Since then, more than 45 years have passed, and then we realized that again the same topic has become now topic of importance for two reasons, because the complete provisions have been rehauled, and there are some old decision of the Supreme Court which has unsettled the settled law that also we need to consider. Mansukh dying, which we'll have to see. So from the topics, what you will see, that we will try to cover what is the new scheme of taxation which came in the Finance Act 21. How is this comparable with the old provision of earlier provisions of 45.4? Then we'll get some illustrative case studies and some illustrative issues so as to highlight what are the salient features of the new scheme, so that at least we are able to understand the provisions clearly and at least get clarity on what is it new provisions are trying to place before us. I think that's what is need to be considered. Friends, as we have seen, new provisions have really opened up quite a lot for all of us. However, it is very important for us to understand the purpose and objective of this provision, and whether the purpose and objective for which these provisions have been brought in by the government, has it achieved the purpose for which it is brought in. We always believe that we at the institute or as a true professionals are here to help the government to ensure that right taxes are being collected and at right manner without any disturbance or harassment to the taxpayer as such. So therefore, keeping that in mind, whatever recommendation we want to give it post this our presentation, or collectively what all of feel or direct tax committee feels, I think we should make a representation to the government as to what provisions we need little modification or need clarifications are required, and accordingly we can proceed further. I think that is the way constructive suggestions could be given. As Sanjay ji rightly said, it is our help to our duty to assist the government to do the right provisions. So always before I proceed, always I believe what I read and reread from the Palkhiwala's book. I will only read 2 lines, which is what is relevant for when we try to understand the new provisions. The law and practice of Palkhiwala's book in Law and Practice of Income Tax says, every government has right to levy taxes, right to levy the taxes, but no government has a right in the process of extracting tax to cause misery and harassment to the taxpayer, and in galling feeling that he is made a victim of culpable injustice. I think that is what is the crucial aspect which we need to keep in mind. And then keeping this in mind, we have to see what is the old provisions and what are the new provisions. Now, when we go to the
Yes, sir. Continue.
When we go to the provisions, we'll quickly run through what is the erstwhile scheme and what is the new scheme which is coming. Now, as all of us are familiar, there was a provisions called Section 45.4 in the old Income Tax Act of 1961, which provided for capital gains on the taxation in the hands of firm on the transfer of capital asset to the partners by way of distribution on the dissolution or otherwise. Please note the words. What was required to be considered is whether there is a transfer of capital asset to the partner by way of a distribution on dissolution or otherwise. I think that's the crucial words which we need to consider. If all those conditions are satisfied, then what is to be seen is how the capital gain is to be worked out. The provision itself says fair market value of the capital asset on the date of distribution minus the cost or WDV is to be treated as a gain to the partner who is receiving capital asset. This is really as good as saying if firm would have sold the asset to the outsider and distributed money to the partner, that what would have been tax liability in the firm. That is what was sought to be covered in this. The dispute started as to when it said the dissolution or otherwise, does it cover the cases of retirement also? The A. Naik's case in Bombay High Court in 265 ITR took a view that yes, retirement also triggers this 45(4) if there is a transfer of capital asset. It need not be necessarily on dissolution. It can be even on the retirement. As against that, there are several decisions which had taken view that when there is a distribution of asset, then it does not trigger 45(4) if it is on the retirement and not on the dissolution. It also had several other decisions which said when the partner retires from the firm and takes in settlement of his account in cash, even beyond his capital balance, it is not hit by 45(4). And there are a host of decisions. And if we look at the right from the history, and as we could see, the first decision which was given was by in case of Mohanbhai Pamawai's case, which was the landmark decision of this our time, that is the Gujarat High Court decision, which was ultimately affirmed by the Supreme Court. It was 91 ITR. That was the first decision, which has relied upon Adakin Arampa's decision, which is 1966, Supreme Court, page 1300 page. That was the first decision which laid down what are the rights and duties of the partner vis-a-vis the firm, and is the firm a separate legal entity or is a collective body of the partners, and only for the purpose of taxation it has been assessed as a firm in the Income Tax Act. So that was the main purpose, and then the host of decisions. So virtually what used to happen was, or what happened up to 21 was, whenever partner receives as his share in the firm something more than what his capital balance is, then it was held to be there is not a transfer of his partnership interest, therefore is not taxable, and which was affirmed by Supreme Court in Sunil Siddharth Bhai's case. Thereafter, there are several decisions of Karnataka High Court full bench, then Madras High Court, then Bombay High Court, and all the high courts took almost a similar view. In effect, what was happening was when the partner takes any money from the firm, even though more than his capital account, still it was not chargeable to tax. Except in case of a specific cases of 45(4), where if the asset is actually distributed to the partner on dissolution or including retirement, then these provisions came in. Recently, the issue has again come up before the Supreme Court in case of Mansukh Dang, which we'll touch upon a little later after we see the comparison of old and new provision. But that is more or less affirmed the decision of A. Naik's case, and that was more or less going on that line. But just to understand, there was most of the decisions were saying when the partner receives something from the firm, even though more than his capital account, it is not taxable either in the hands of firm or in the hands of partner. That was a main issue which was going through. Keeping that in mind, the new scheme was brought in by Finance Act 21. As all of you are aware, when the scheme was brought in, amendment was brought in, what was the finance minister said in the speech, and which is very interesting to read, and then we'll have to see how that has been spelled out in the various provisions. Taxability of surplus amount received by the partners. As we discussed, most of the decisions have taken a view that surplus amount is not taxable if it is received by on retirement. So that was the first point on which they wanted to cover, that every partner, if he receives something more, then it should get taxed in the hands of partner. Therefore, in order to provide certainty, it is proposed to rationalize the provisions relating to the taxation of assets and the amount received by the partners from partnership firm in excess of their capital contribution. So I think all of us will agree there are no two opinions that if government wanted to ensure after 50 years or 60 years that they want now every excess amount received by the partner should be taxed, then this provision was absolutely necessary to be brought in. So indirectly, what we were saying is, if partner receives something more than its capital balance, it should be taxed, which is what Finance Minister said in her speech. Same way, if some assets are distributed, instead of selling the assets, if the assets itself are distributed by the firm, yes, it is as good as encashing the assets. So that also should be taxed on the difference between market value and the book value of the assets in the hands of firm. So therefore, this objective was very clear, purpose was very clear, and this was supposed to be for the rationalization measure. The provisions as came in the finance bill got substantially modified when the bill became act. And then we had not only the provisions of section 45(4) completely overall, but also we had another provision called 9B was also introduced to cover in case of a distribution of stock in trade or cash or capital asset. All three got covered in section 9B as well as section 45(4). Exact issues covering that we'll just touch upon with little slide. But what is sought to be covered is every transaction should get taxed. And certain cases you will notice in case of distribution of capital asset, it is virtually double taxation. Once firm will pay tax, and again firm will pay tax on the basis of partner in under 45(4). So that is what we'll just, based on the subsequent slides, we'll know how this provision is getting attracted. So therefore, we'll have to see whether provisions as it's spelled out or as is being brought in the statute, does it achieve the purpose of rationalization, or something it is excessive taxation has happened in the provision, or is going to create more litigation, more difficulties compared to what was settled principle by the judicial cases. Now, let us see section 9B. What is this slide says about 9B? What does section 9B says? It provides for taxation on firm by deeming receipt of capital asset or stock in trade, both by a specified person, that is partner, from a specified entity, that is firm, in connection with dissolution or reconstitution, and is deemed to be a transfer and therefore taxable as such. Now, what it says is the tax will be recovered from the firm in the same manner as would have been transferred such assets in favor of the outsider. The second point says any profits and gains arising from such deed transfer will be deemed to be the income of the firm, then chargeable as capital gain or business income in accordance with the provisions of the Act. And why this provision was amended to cover was to cover the stock in trade also, which could not have come in section 45(4) because 45(4) is in the chapter containing capital gains provision. So therefore, business income or stock in trade could not have been covered there. So therefore, it had to be separate provision had to be brought in, which is contains in the separate special provisions dealing with certain types of transfers, and it came in section by way of 9B. Now, how it works it? FMV of the capital asset or stock in trade or both on the date of such receipt by a partner is deemed to be full value of consideration received or accruing. Therefore, if there is a distribution of stock in trade or capital asset by the firm, either on the dissolution or the deconstitution, it will be chargeable to tax under section 9B on the difference between fair market value of capital asset or stock in trade and the book value of the asset in the books of the firm. Now, when we see this definition of specified entity or a person, specified entity covers not only the partnership form, it covers LLP, it covers the AOP, it covers the BOI. So there is a wide spectrum of specified entity. So therefore, any of these entities are distributing the capital asset or stock in trade to its partner, then these provisions will get triggered. So that is the part one. But it is important to note that if there is a pure cash distribution, suppose somebody retires, if it is a cash distribution, Section 9B will not have application because it doesn't cover distribution of cash for the retirement of a partner or reconstitution of the firm. So therefore, that is important point, which is sought to be covered separately in Section 45.4. Let's refer to the Section 45.4. Now, Section 45.4 says it levies the capital gain tax. Its words are very important on realization by a partner in excess of capital account balance, excess of capital account balance in connection with the reconstitution. Now, here it does not talk about dissolution, but it talks about reconstitution. And rightly so, we'll come to the definition of reconstitution. Gains are computed from the partner's perspective, but are taxable in the hands of firm. So as we have seen, when it was 9B, it did not refer to whether there is excess of capital account balance of the partner. It only said if there is a distribution of stock in trade or capital asset, any value of excess value, market value, will be over the book value of the asset. A book value of the asset in the books of firm will be chargeable in the tax of the firm. But when it comes to the 45.4, it says if the partner receives more than his capital balance, then the excess is chargeable in the hands of firm as is computed in the hands of a partner. So that's a clear distinction between the two. First, it talks of a taxation of excess realization over the book value versus second is excess amount received by a partner over his capital balance. These are the two different provisions we need to consider, and how that both the provisions have been interlinked now, which we'll see as when we see the examples, we'll come to that. Now, how it is to be worked out? It says value of money, that is the cash received by the partner, that is B, fair market value of the assets on the date of such receipt. That is important. So cash plus the fair market value of the asset minus the capital balance in the books of in the name of the partner is the surplus, which will be liable as a capital gain chargeable as the income of the firm. So even though the computation is for the purpose of taxability of income in the form of capital gain in the hands of partner, it is being recovered from the firm, and therefore all the taxability has been examined in the hands of firm, which is similar to what was there in earlier 45.4. Now that certain assets have been treated as a nil value, like self-generated assets like goodwill, or assets means other assets which are not acquired for payment of consideration, it will not be considered as a value, and therefore that will be excluded. Therefore, actual value of money received as well as fair market or capital asset, if it exceeds the capital balance, it will be chargeable to tax. That is what is important to be considered. Now let's see what is the definition of specified entity. As I was referring to, specified entity means firm, LLP, AOP, or BOI. As all of us are aware, in the Income Tax Act, the taxability of all the four entities is almost the same like that of a firm and by of an independent entity. So therefore, it does not really make a difference. So therefore, they have classified, they have specified as a specified entity. However, if it is distribution from company, which has separate provisions like Section 46 and 222A to D, there are separate provisions for a company and cooperative society. So they are not covered by these provisions. Now, what is specified person has been person who is partner of the firm or member of AOP or BOI in any previous year. So again, important for us to note that wordings are means a person who is a partner of the firm in the relevant previous year. So therefore, again, when we go back to the provisions, we need to see exactly what does that signify. When the capital asset is received by wording section 45 says, when capital asset is received by a partner, form a firm in connection with reconstitution of the firm shall operate in addition to section 9B, and taxation of 9B shall be worked out independently. So therefore, as I was referring to, if the capital asset is distributed, it will be covered by both the sections, or it will be taxed under both the sections, that is 9B and 45(4). But if it is a cash is distributed, it will get covered only in section 45(4). But if it is a stock in trade, again, it will be covered only by 9B. So therefore, it has a significance. When we go to the examples, we will come to know what is the significance of these different treatments or different terminology or taxation provisions. Now, this is interesting to understand the definition of reconstitution, because as all of us are aware, there was a host of litigation on what is called reconstitution. And as we have seen, A. Naik's case versus Karnataka, Bombay, and other high courts, what they have taken view, which ultimately went to Supreme Court for the Mansukh Dai's case, that need to be understood, which is in the later stage. So therefore, in right perspective, legislative thought it fit to define what is meant by reconstitution. And very important, a very broad definition has been given in the Income Tax Act, in the section 45(4), what is meant by reconstitution. It says, where one or more partners ceases to be partner, retirement or death of the partner will get covered in the reconstitution. One or more new partners are admitted in such circumstances that are one or more persons who were partners before the change and continue as such after the change. So that's a question of admission of a new partner. And third, all partners continue with the change in their respective shares or in the shares of some of them. So even change of constitution without retirement or admission of a new partner, if there is change in constitution of the partners, it will be treated as a reconstitution. And if there is anything surplus received on the reconstitution by any of the partner, that will also get triggered applicability of section 9B or section 45(4), depends on what is exactly the distributed. There is interesting provision, which is the new way of drafting the legislation, which we have been seeing last few years, is they give power to the administrative body like CBDT to say that for removal of difficulties or to give effect to the above provisions, they can issue guidelines which need to be placed before the House of Parliament. However, these will be binding. Note these words. These will be both binding. This will be binding on both taxpayer and tax authority. Similar provisions have come in latest, all these amendments, when you come to 194R and all those provisions, these similar provisions have been brought in there. So therefore, importance is, as we are historically aware of, as per judicial precedents are, only beneficial circulars were binding on the department. Circulars were never binding on the taxpayer. He had right to say whether to apply or not to apply. If it is beneficial, it was always been helpful for him to use those circulars and use it. But now, as per this new provision, as per section 9B(4), the clarifications issued for so-called for removing difficulties are now binding effect. And when we go to the little later stages, we'll notice that the scope of the provisions has been considerably extended. Section 9B and 45(4) scope has been considerably extended by these circulars as well as by rule-making authority, that is rules. Now, whether this is constitutionally valid, not valid, that's a later provision. But I think we as a profession or as a member of institute, we should consider this to recommend to the government, whatever they want to do it, it should be by law and not by giving power to the rule-making authority or to the CBDT to draft certain things in the guise of removing of difficulties and change the whole structure of the provision itself. Whatever government wants, let it be specified. But it should not be left to the discretion of the CBDT or rule-making authority to lay down certain law which is not as per the main provisions of the law. I think that is what our responsibility as an institute. I think we'll have to take it up this, and which we'll discuss with the committee separately and see how best we could take it up with the government. And this circular, as I was mentioning, circular came number 14 of 2021 on 2nd July 21. So therefore, this circular has importance, and it will touch upon when we go to the examples. We'll need to consider this exactly the examples. So because how this scope has been extended by rules, which also will deal with the rules, and also this circular, and which has implications on the computation of the capital gains. Now, just to quickly compare the two provisions, I won't take much time for yours, but it is important for us to understand what was covered in erstwhile 45.4 and what is covered by 9B and 45.4. The important point to be noted is the event of trigger of taxability. Transfer of capital asset by way of a distribution on dissolution or otherwise. There was no reference to stock in trade, no reference to the cash distribution. It was only transfer of capital asset. Again, there was no question of a reconstitution. There was no question of a modification of mutual rights of the partners when there is no retirement or admission of a partner. This provision did not trigger. So therefore, that was the law which we all understood up to 31st of March 2020. Form 1421, 1420, the law has been amended. So as I was mentioning, law has been amended by Finance Act 2020, 21, but with retroactive effect from 1/4/20. So because the bill was presented in the month of February 21, it was passed in sometime in the May, but it became applicable from the earlier date, that is 1/4/20, and that is why in the interpretation language they say it is a retroactive provision. So all the transactions which have taken place prior to the date of amendment, without calling it a retrospective amendment, it became applicable to the past transactions. This also becomes evident when we see the circular, which we saw the circular. Circular is dated July 21. Now, but July 21 circular is made applicable for the transactions from 1/4/20. Now, how far that is valid is the courts will decide. But I think this type of situation we need to represent, and what I read from Palkhiwala's commentary, this is what is not expected to. Whatever government wants can be legislated, but it should be prospective. So there should be sufficient time for them to adjust their or arrange their affairs so that at least they are not unduly troubled by this so-called retrospective or retroactive amendments. I think that is what is there. And present government has been always been saying that they do not want to, and they have stick to their word that they have not carried out any retrospective amendment. But this type of retroactive amendments are sometimes troubling and unnecessarily is creating a lot of litigation and heartburns, as well as to the trouble to the taxpayers, which will come to when we see the example, we'll see. Now, as I was mentioning, provision came from May 21, Act was passed in 21, and what it says is receipt of capital asset or stock in trade or both by a partner in connection with the dissolution will be covered under 9B. When it comes to 45, it covers money or capital asset or both in the connection with the reconstitution form. So therefore, look at the wording. There is a slight variation in the wording. Remaining point are more or less the same, is not something different. But what we are trying to say is, when it comes to 9B, excess value of the asset distributed over the book value is taxable, irrespective of what was his capital balance. I'll give you an example. Suppose a partner has a capital balance in the firm of 10 lakhs rupees. He gets a stock in trade from the firm which has a value of 9 lakh rupees in full settlement of his account. That value of the book stock in trade is more than the book value. So I say book value of their asset is 7 lakh rupees and the market value of that asset is 9 lakh rupees, firm will pay tax of 2 lakh rupees when the partner is receiving less than his capital balance. So when we look to the provision or objective of this provision is completely getting frustrated, because purpose was anything partner getting over and above his capital balance must get taxed in that right. Rightly so. We have no two opinions about it. So also, if the firm distributes any capital asset or stock in trade which has a more value than the book value, yes, it should be taxed, no problem. But it has to be synchronized with the capital balance for whom it is paid. So therefore, 9B to that extent goes beyond the scope and saying it is taxing the partner over and above his capital balance, though he is not receiving over and above his capital balance. So therefore, to that extent, this provision has goes beyond what was the objective and intention of this provision. That is part 1. Now, part 2, when we go to the 45.4, it refers to the money or capital asset. But if the capital asset is common in both the sections, so therefore, if capital asset is distributed, not only that excess money, the excess value which is there in the hands of firm will get taxed in 9B. Over and above that, what partner gets excess in the capital asset will get taxed in 45.4. So to that extent, whether it's double taxation or this is the true intention of the legislation, we need to see, and then it is considered. If somebody asks us what, or they ask institute, what is the rational provision it should be, I would say if firm distributes any asset for which they get excess amount, should be taxed in the hands of firm. No dispute. If partner gets something more than his capital account, let it be taxed in his hands. Let him pay the taxes as may be required, and he will be subject to the respective provisions. By complicating this provision, by introducing 9B variation and 45.4, it is only going to unnecessarily create a litigation for a long time to come. And these provisions are yet to be tested because last year's returns have just gone. That is the first year of 21-22, and now 22-23, 23-24 returns will go. So now that all those litigations will start seeing this because of this interpretation. So therefore, this is the point which I think we should keep in mind. Now, other provisions, now which I was referring to, cost of acquisition, everything, this is more or less the same provisions, not much of a difference. Therefore, what we need to consider is the scope of this provision. As we saw, the scope of reconstitution, specified entity and specified person has been completely extended. And as I was mentioning, CBDT has been given power to issue guidelines for so-called removal of difficulties, but they are not done only on difficulties. They have extended the scope and made binding precedent of those circulars. Now, I have selected some case studies only for the purpose of understanding the scope of these various provisions. These are only illustrative cases. It is not something which we need to really take it as any particular view from that point of view, but only for examining what is the provision is. Now, this case is a partnership firm with 4 partners. Each one has contributed 5,000 rupees. Partnership firm has a land acquired at cost of 1,000 rupees, whose FMV is 5,000 rupees, obtained through valuation report. Land is held to be a long-term capital asset. Now here, why X retires from the firm and his amount shows there is some balance. So he's been paid cash of 6,000 rupees after considering value of land. So as could be seen, against the capital balance of 5,000 rupees, he has got 6,000 rupees by way of cash. So question is whether the excess amount, which is 1,000 rupees, is it chargeable to tax? Now, as we have seen, which section will apply? Whether 9B will apply or 45.4 will apply. As we have seen, as we had discussed earlier, section 9B will not trigger as there is no distribution of capital asset or stock in trade. It is only the cash which is distributed. Therefore, section 45.4 will trigger, and what is excess amount received by him over his capital balance is 1,000 rupees, which will become taxable in hands. There is another provision which is covered in section 48.3, I would say, is very good provision to avoid multiplicity of the taxes. They have said if there is any other asset in the firm, to the extent of excess amount paid, that is 1,000 rupees, which is attributed towards revaluation land, will be allowed to be reduced from the sale proceeds of the land whenever it is sold. In our case, there is a land which has a value, 1,000 rupees is the value, market value is 5,000. When it is sold, the excess, if it is received, Section 48(3) permits us to reduce that 1,000 rupees and only balanced amount will get taxable. So it's a good and welcome provision, and to that extent, it should be appreciated. This is the simplest example. Now let's go to a little complexity. This is the example where the second example is in respect of the retirement of partners settled through stock in trade. This becomes important compared to, because we are trying to compare Section 9B versus Section 45(4). In first example, we saw it was a distribution of cash, therefore 45(4) got triggered. When it comes to distribution of stock, then Section 9B will trigger. Now here, what example which we are considered is the partner here, X has retired and he has got half of stock in trade from the firm. So market value of stock in trade is 18,000 rupees, book value of 12,000 rupees. So there is a surplus of 6,000 rupees. Now surplus of 6,000 rupees, if the half of the stock in trade is given to him, then the 3,000 will get taxed in the hands of firm, because it is deemed to have been encashed the stock in trade or sold the stock in trade, and the difference is said to have been taxed in the hands of firm. The important point to be noted here is it has no correlation with the capital balance of the partner. It has a correlation only with the difference between the value of the property or stock in trade and what is distributed to the partner. Therefore, if the value is more than the book value, that difference will be taxable. In our example, difference is 6,000 rupees over and above the cost of the asset, that is 3,000, and therefore 3,000 will become taxable. Half of that, 18,000, 9,000, so 6,000 is the cost, half of the cost, and that will become applicable. Again, as we noticed, since it is the distribution of stock in trade, it will not get covered, it will not be applicable under 45(4). It will be applicable only in 9B, and it has no consequences of other. Again, spread of the cost also will not be available because Section 48(3) talks of only capital asset. When it is sold, that gets spread over the other assets. So therefore, that is also not there. So therefore, this becomes an important point. When 9B is triggered and stock in trade is distributed, irrespective of capital balance of a partner, firm will get taxed if the firm realizes or receives, distributes the stock in trade more than this market value, more than this book value, whatever excess is value, that will get taxed as an income. And here it will not be taxable as a capital gain. It will be taxable as a business income because it is a sale of a stock or deemed sale of a stock in trade. That is the important point which we need to mention. The third important aspect which we now consider is in respect of partner's account settled through capital asset. Partner's account is settled through settlement of capital asset. Now, this is important point because this triggers both the sections, and with hardship which we are talking about will get highlighted here. Now, in this transaction, what is happening is there are 4 partners having capital balance of all 4 of them having capital balance of 5,000 rupees. A1 is retiring and his account is settled by giving land of which FMV is 9,000 rupees. Here, both Section 9B and Section 45(4) will apply, and assume tax rates of long-term capital gain at 20%, and short-term capital gain is, I think, typo error. It is not 15%, it is 30%, because 15% is only in case of a listed certain, when the sale of stocks are sold, listed shares or stocks are sold, then it's 15%. Otherwise, all other assets, short-term capital gain is 30%. So it is either 20% or 30%. So in this case, what is the situation? The capital asset is distributed. So first trigger will be, or first liability will be under 9B, because if the value of the property is more than the book value, then that difference will be first taxed as a long-term capital gain. Now, in this case, the asset which is distributed is the capital asset of the firm, which has a value of 9,000 rupees and book value of 7,000 rupees. And therefore, long-term capital gain of 2,000 rupees will be taxable and tax at 20% will apply. Now, this is one tax, and for which we have to consider how the cost spread or a spread happens over the other assets, which will come to a little later. So here, as we see, tax of 400 has been paid and amount to be distributed in the profit sharing ratio for the purpose of 45(3) is 1,600 rupees, which we'll see on the next slide. The capital gains tax liability will be 9,000 rupees received by a partner. Here we have to see the capital balance. His capital balance was 5,000 rupees. That earlier, what we said, profit sharing ratio, the surplus 1,600 rupees to be divided into 4 partners. That came to 400 rupees, so 5,400 rupees. And therefore, the capital balance is 3,600 rupees and not 4,000 rupees, because the 400 credit has been given by the provision, which I said is a good provision. To that extent, the tax liability has been reduced to in the provision. So therefore, here both things have happened. The realization by the firm of the distribution of assets is taken at a market value and distribution is taxed at that value. That is first tax which is levied under 9B. Excess tax paid has been given credit in the hands of, after payment of excess tax, the credit has been given in the hands of partner, in the hands of firm for the purpose of working out tax liability under 45(4), which is what is exactly spelled out. So therefore, and whatever is the tax paid when firm sells off that asset, which is remaining asset, what we saw, there is remaining assets which are there if it's sold, that excess tax paid will get spread over the other cost in the profit sharing ratio under in the proportion of various assets held by the firm under section 45(3). So therefore, this has to be read with rule 8AA5. So therefore, section 48(3) and 8AA5 are very important whenever any capital asset is sold by the firm or distributed, where capital asset is distributed by the firm among the partner on reconstitution of the firm. So therefore, this becomes important and we have to carefully look to the provisions. As I said, there is a 15% or 20% not correct, 30 or 20% should be there. And therefore, to that extent, we need to examine and carefully, and also how the surplus or taxes paid gets spread over the partner's capital account need to be seen while working out 45(4), which is double taxation. Plus, we have to also see that taxes paid gets allocated to the remaining assets of the capital assets of the firm. So whenever firm sells those assets, that also will be taxable here. So therefore, this example becomes important for us to consider. Now here is again very important point to be considered. As we've seen, the rate of tax is 20% in case of long-term capital gain and 30% in case of a short-term capital gain. Now, as we are all aware, short-term capital gain is, if there is an immovable property, it is a 2 years time. If there are any other assets, it is 3 years time. However, there is a dimming fiction created by rules, not by act, again by rules. If it is a self-generated goodwill or intangible asset, it will be deemed to be part of a short-term capital. It will be deemed to be short-term capital asset, and therefore gain on that will be short-term capital gain. So that's the important point to be noted. Similarly, when the capital asset is forming part of the block of asset, it will be again treated as a short-term capital asset, and it will be gain will be short-term capital gain. So therefore, this need to be considered. If there is a stock in trade, section 45(4) will not have applicability. It will be only applicable only in case of a 9B. It will not be applicable here. So therefore, that classification may not be relevant. But short-term, in case of capital asset, definitely it will be applicable both in the case of 9B as well as section 45(4). So therefore, that need to be considered. So therefore, except this assets, which are self-generated assets like goodwill and intangible assets, all other assets will be treated as long-term capital asset, and therefore it will be treated as liability to 20%. Many questions do come to us for discussion as to if the firm, if the partner retires from the firm and gives up his right title interest to the firm, what he receives. And if he is in the firm for more than 3 years, will it be short-term or long-term? Because what we are comparing here is if it is given by cash consideration, we have to consider whether he is in the firm for more than 3 years or not in 3 years. If he is in the firm for more than 3 years, in my personal view, it is a long-term capital, because what he is giving up his right title interest in the firm. And for giving up his right title interest in the firm, he is getting the consideration which is excess to his capital account. And therefore, that will be liable for long-term capital gains. If there is a distribution of capital asset, then as we discussed, 9B will trigger as well as 45(4) will trigger. 9B will only tax to the extent of difference between market value and stock in trade. Market value on the book value of the asset. If there is any difference, that will get taxed in 9B. Credit to certain extent is given in the hands of partner, in the hands of firm for calculation of taxes. That could also happen. So therefore, that need to be carefully seen. And therefore, this becomes very crucial for us to understand which is going to be short-term capital gain or which is long-term capital gain. Merely because partner gets a cash consideration does not become a short-term capital gain, merely because firm has only work in progress or liquid assets. That does not mean, but because as we have discussed right from Adaki Narayanappa's case, right up to Sunil Siddharth Bhai and Mohan Pamabhai, it is very clear. Fundamentally, law is very clear. Partner does not have any specific rights in any of the assets. His right or his asset is what is my right title interest in the firm. If I am giving up that right title interest, whatever I get, it is my capital asset, giving up capital asset. And if I am partner in the firm for more than 3 years, it will be long-term capital gain and not short-term capital gain. I think that need to be kept in mind. And when it comes to the retirement of a partner and when it's given for his right title interest, we need to be carefully in seeing that we don't have to go by what assets are owned by the firm. And that is not the criteria to be determined whether short-term or long-term. And there are enough precedences of our earlier decisions which are available, which has clarified this point. Now, other important point which we need to consider is applicability of Rule 8(1)(b). As we have seen, I briefly explained, if there is any tax paid under 9B or Section 45(4) for excess realization, then that excess realization or tax paid thereon gets spread over the remaining assets of the firm, remaining capital assets of the firm. And in case of a subsequent sale of those capital assets, that value will be, that sale proceeds will be reduced to that extent while working out the capital gain of the sale of the subsequent assets. So therefore, that will be applicable. But that benefit is not available in case of a sale of a stock in trade, because sale of stock in trade is taxable only in 9B, and there is no provision for spread over of that cost under Section 48(3), that is available only in capital asset. And in my view, it is for the purpose of double taxation which is happening, that is in the 9B as well as 45(4). Certain relief is sought to be given by a spread over the cost or the spread of the tax paid over the remaining assets. So that is one of the reasons why this has been done. So therefore, according to me, rightly so, but this whole provision has become so complex because it is not originating from the Act, but is coming by a circular and by a rule, which we'll discuss in later cases, whether it is binding and whether this is constitutionally valid. That will touch upon little later, but this is what is creating little difficulty, and which we discussed long-term capital assets and long-term capital gain, whether ultra-wise, not ultra-wise, that we need to examine. Now, the next point which we need to consider is where goodwill is being sold, whether goodwill is there in the firm, it has been valued. If there is a goodwill, as we discussed earlier, value of that is to be treated as a nil. FMV value is 3,000, but cost of that is self-acquired or self-generated or created asset, then that value of has to be considered as a nil. In that case, how that capital asset has to be, how the capital gain has to be worked out, need to be seen. Here, there were three partners and equal profit sharing ratio, equal capital contribution. Land acquired at the rate 1,500 rupees and FMB was 2,100. Land is long-term capital asset. Firm has a self-generated goodwill value at 3,000 rupees, which is a market value, a fair market value. Firm retires and he gets the cash. X is paid 1,700 rupees. That is, his capital is 500 rupees, but he is paid 1,700 rupees. Then it will be represented by a capital of 500 rupees plus 1/3 share in the appreciation of the assets. Therefore, he will be liable for tax on two sections, 9B as well as 45(4). But since he is paid in cash, only 45(4) will apply. 1,700 minus 500 rupees, that is his capital balance. So he will be liable only for 1,200. As there is no distribution of capital asset or stock in trade, that has not been applicable. So therefore, question is short term or long term, that issue will come up. And here, as I was mentioning earlier, the document of your retirement or document of partner going out will become very relevant if you specifically say that this is on the revaluation of the capital asset, revaluation of goodwill, this amount has been paid. Then the question of short term and long term will trigger. If it is towards the goodwill, it will be short term capital gain. If it is connected to other assets, it will be long term capital asset. The safer view, I would always say, when the partner retires from the firm, it should say towards his right title interest in the firm, he is being paid X amount, and that will become account to me long-term capital gain. And to that extent, you can have the saving of tax of 10%, 20 instead of 30, it will be 20%. So therefore, document for such a purpose becomes very crucial. And therefore, as our responsibility as a professional is to guide the clients properly while drafting agreements. But as we are aware, most of the time agreements are drafted at solicitors or law firms. And when it comes towards transaction, it's much later. But anyway, whenever it comes to you for your advice, I think it is good to advise them that if you specify something about goodwill or any other intangible asset, then it will be liable at a higher rate, as at 30% as short-term capital gain, not as a short-term, as a long-term capital gain. Now, which I was referring to about whether provisions will fail. I think that's what is the interesting part to be considered. When we see Section 45(4) does not talk of a short-term or capital gain. It comes only by her rules. That is 8(1)(a), 8(a)(5). Now, can the rule change the character or taxability, mode of taxability in the hands of firm? We have enough number of decisions to say, and if we see even the income tax decisions of Lohia Machines, which was one of the first decision of the Supreme Court, which has laid down, rule cannot override the act. Rules has to serve the purpose for which provisions have been created. So therefore, if the act doesn't specify short-term or long-term, can by rules or circular say that this is a short-term or long-term gain? According to me, this will be matter of litigation, and therefore, if legislation does not want to get into litigation, it will be safer. It will be good for our institute to recommend to them, whatever you want to do it, please pass or incorporate in the act itself, but don't leave it to the CBDT or by rule-making authority. It will get challenged because there are enough number of Supreme Court decisions to say that rule cannot override the act. And therefore, that could create problem at a later stage and litigation could happen. So therefore, it is right for government to amend at the appropriate time instead of waiting for the litigation and then the make amendment after 10 or 15 years. Then the next point which we are referring to is in respect of certain aspects, other illustrated cases which we need to consider. Here I was referring to the rule, and that when we are discussing, as all of us are aware, rule which was prevailing on the first day of the assessment year is binding for the full year. As we were discussing, the amendment in the section 9B or section 45(4) came in the statute after passing of the bill, which happened in the May 21. But it is made retroactive, applicable from the transactions happened after 1/4/2020. The rule clarifying whatever the provisions or removing hardship, whatever they have issued circular, is effective 2nd July 21. Now, if rules and circular came in July 21, can it be said that it is applicable retrospectively for 1/4/2020? Supreme Court in various cases have said the rule cannot, law has to be applied based on the law as was there prevailing on the first day of the year. Law could be retroactive, but the rules or circular cannot be retroactive or retrospective. It has to be only prospective, and that can happen only from 2nd July 21. So therefore, my personal feel is this matter is going to be highly litigative, because these provisions, the rules, which is change the whole character of the section or increase the scope of the section, is made effective from 2nd July 21 by rules as well as the act. It can't really bind for the assessment year 2021, and even to the extent of 21-22 also, certain extent it may not be, because the rules came from only 2nd January 21. So therefore, rule which was not prevailing on the first day of the assessment year only will not be binding for the whole year. So therefore, there could be difficulty in both the years on taxability, and the taxability will have to be examined purely on the basis of interpretation of the section without aid of rules or the circular. Therefore, that becomes important, and at the appropriate time, appropriate cases, matter needs to be taken up by the institute as well as the professionals at appropriate level to guide the government. This is what we have done. It could create a litigation at a later stage. Some of the illustrative issues I would like to quickly run through within the time allowed to us, so that at least we are all on the same page. And this is an important point to be considered. Now, section 45(4) triggered upon partner retiring from the firm or upon actual receipt of the firm. Now, take this example why it is important. Now, partner has retired from March 21 when the act is become applicable, that is from assessment year 21-22, whose account is settled in March 22 by cash payment. So, cash payment is happened in March 22. Whether 45(4) will trigger for financial year 2021, that is assessment year 21-22 or 22-23. Because if we go back to the wording, what it says is amount distributed by a specified entity to the specified person will be taxable in the receipt of that amount. So now in this case, the specified entity is a partnership firm. Specified entity has distributed cash in 21, that is earlier year. Can the taxability will happen in 22 when the amount is received, or will it happen in assessment year 20 when he actually retired? The third point, which we'll consider a little later, is it has to be a relation of a specified person and specified entity when the amount is received. Now, in this case, in 22, he is no more a specified person because he is already retired. He is no more receiving from the specified entity because partnership form continues, but he is not a specified person as required by the Act. So therefore, this is going to be a highly debated issue as to word receives, because section 45(4) clearly says received by the partner, actual receipt by the partner from the firm. Therefore, mere acknowledgement of debt in favor of retirement partner is not sufficient to tax, and therefore could be litigation on this point with the receipt itself, because wording is a receipt and is not something accrual. And mere credit of entry is not a receipt for the purpose of this section. And as we have all discussed, these are deeming provisions. So deeming provisions has to be strictly construed. The next issue which need to be considered is in respect of, is it prospective or retrospective? As we discussed earlier, provisions came from 1/4/20 and it is made applicable for first time, and this act became applicable from assessment year 21-22. Now in this case, partner has retired in March 20 and he is account is settled in April 20 by cash payment. Now, can we say that provision is applicable to him? In my personal view, since the partner has retired in March 20, old law will apply to him. Old provisions will have to be examined under old 45.4 will have to be examined. And then depends on whatever taxability happens in those sections as per the law laid down by the courts, we'll have to examine it. Merely because cash is received by him in the month of April 20 cannot bring in the taxability under the new provisions of the law. Because what is important is retirement of a partner from the firm and write what he's got from the firm. And this you have to compare with the earlier example, there's a contradiction. Because there we are already in the new provision. The new provision clearly says he is taxable only on the receipt of the amount. Here, this is not the case of new provision applicable. Here, you are retiring under old provision. Merely because you have received the amount in later period, you can't be brought in under the new provision. It will continue to be under old provision. Therefore, my personal view is this transaction will not become taxable under the new provision. It has to be examined under the old provision. The next example is again slightly similar, but a little more, bringing in more aspect of it. Again, partner is retired in 2020. His account is settled by distribution of capital asset. Is 9B triggered, which is effective from 21-22? As I explained in earlier example, the transaction is assessment year 2021, which is not covered by the new amendment. And therefore, even if stock in trade is distributed, it will have to be examined taxability under the old law and not as per the new law. So therefore, that is important. That is my personal view is that is what is required to be considered. The next important point is, again, very interesting issue is look at the facts of this case. There are three partners. Ex-partner retires from 1st January 21. Value of his interest determined at 3,000 rupees, which is payable in cash by LLP to him at the end of 3 years. That is 31st January 23. He is going to get money after 3 years' time. He is retired on 1st January 21. Money is going to come to him in assessment year 24-25. In the books, he is shown as a creditor. Post his retirement, the firm is converted into LLP. Firm is converted from LLP to a limited company. Now, ultimate amount in 23 is settled by a company to the erstwhile partner of a erstwhile firm. Now, there are two things which we need to consider. In 23, December 23, neither he is a specified person of that entity, nor the specified entity in existence. So both the conditions are not getting satisfied. So therefore, will the charge of 45.4 fail in this example? So therefore, this is going to be a litigative issue, and appropriate cases, matters may have to be litigated. But personal feeling is this is going to be a matter of litigation. How will courts look at it? If the present trend of courts continues, the provision will be read down and will be held to be liable. But if the strict interpretation of law is considered, according to me, it is a good case to fight out. It is not taxable because neither specified entity nor specified person definition is getting satisfied to attract either section 9B or section 45.4. The next example is again slightly modification to the earlier example. Just to bring out, if there is a negative balance in the partner's account, what happens? Now, let's take a case that there is no withdrawal by partner when he retired. Now, let's take a situation. Partner sorry, different example. Yeah. So I think we have seen this corporatization form. Yeah. So next example is partner negative balance. I think that is what is important to be seen. Now let's take a situation that partner has withdrawn the amount before 1/4/2020, before the new act came in the picture. He retired under the new law and he's been paid the amount and his capital is negative capital. Question is, if there was a negative capital and he's been paid a certain amount, which is over and above his negative capital. Suppose he had a negative capital, as we've seen in the next page, he had a negative capital because he had already withdrawn the amount. His opening balance was 1,000. Leave apart revaluation. If we ignore the devaluation, he has a negative balance of 1,500 rupees. So if he's paid 2,000 rupees, he has got over and above his capital balance more amount than what his capital balance is, more than almost about 1,500 rupees, 2,500 more amount, 1,500 excess amount. Will that excess amount be taxable in the hands? My personal feeling is when the negative balance is there and he's been paid more amount, negative has to be added for the purpose of determining what is the amount which is taxable in his hands for the purpose of determining. So therefore, merely because you have withdrawn the amount earlier and your account has become negative balance does not mean that you will be not liable to be the tax in the provisions. Therefore, that need to be considered. And excluding revaluation, you have to see the situation. And if there is a negative balance, that will become taxable. Depends on the asset distributed or whether it's cash distributed. In our example, this is 45.4. So therefore, ignoring that, 45.4 will trigger and it will be chargeable to tax because 500 rupees, what is closing balance, what he's got something more. Therefore, ignoring negative balance, he will be chargeable to tax. The next issue which need to be considered is if there is a negative balance which is ignored. So again, same example which we saw earlier. If there is a negative balance was there in the partner and partner decide not to pay him but ignore that balance, will that be treated as extra consideration received by the partner? Earlier case, he has been paid over and above his negative balance, but here he has not been paid, but the amount is ignored. His debit balance is ignored by the firm. Question is whether we can take the benefit of Mahindra Mahindra, which says waiver of loan by a creditor results in a debtor having extra cash in hand and receipt in the hands of debtor. So therefore, if we apply the Mahindra Mahindra decision, the waiver also will be treated as extra cash received by partner and it will become taxable. But again, this is going to be litigative, but safer view appears, my personal view appears to be, it will be taxable. Even if there is a waiver of the amount, it will be similar to the negative balance what we saw in earlier example. Now, another interesting issue which I would like to touch in the time available with us is withdrawal of firm's property by the partners in their profit sharing ratio. Now, this becomes important when we compare to the earlier decisions of the Supreme Court, all the cases where the assets have been withdrawn. Now, what has happened here? There are three partners. Partners decide to, this is the case of deceased partner. I jumped the case. Deceased partner's case. Again, same like what we saw earlier, where there is a succession by the firm to the company and the firm had paid the amount to the erstwhile partner. Here, partner has died and his legal heirs have been paid by the firm to the partners. Now, can that be treated as the amount chargeable in the hands of legal heir as a taxable under the 45.4? Now, again, our question is it a specified person which has paid, a specified person which is receiving money from the specified entity? Now, specified person is already died. Specified entity has paid to the legal heirs of a specified person. Therefore, will 45.4 apply? My personal view is, in case of this, it is an inheritance received by a legal heir, and therefore, in my view, 45.4 cannot trigger in such situation because what is received by the person is amount of inheritance of the deceased partner which is received and not something as a partner what he could have received. Therefore, my personal view is that will not become taxable under 45.4. What will happen under any other provisions? That's a different situation, but we are strictly just now considering the issue of 45.4, specified person and specified entity. Now, next issue which we are considering is distribution of property by the partners in their profit sharing ratio. I think this becomes crucial because when we see the old law versus new law, that we need to examine. Now, consider the issue that there are assets in the firm. Accordingly, firm decides to distribute the assets among the firm without any retirement, without any admission, no change of constitution. So see the wording of reconstitution. There has to be admission, there has to be retirement, or there has to be a change of profit sharing ratio. If none of the things happen, but partners have withdrawn the asset, either in their profit sharing ratio, all the partners retired or one of the partners retired, will there be a taxability under section 45(4) or under section 9(b)? Now take a situation that what could trigger under the old law was if there is a distribution of capital asset, either on dissolution or otherwise, as has been interpreted by Mansukh Dain's case, yes, it will become taxable under the old law. But when it comes to the new law, if there is no reconstitution, even if partners have received the asset, will it be taxable in the act? My personal view is, as per strict interpretation of law, that will not become taxable under 45(4), neither under 9(b) nor under 45(4). So therefore, because there is no reconstitution or a dissolution of the firm, therefore both the provisions will not trigger. However, if we see the logic or intention of the provision, yes, their intention was to tax the partners if they receive the asset, and if asset value is more, market value is more than the book value, then it should be taxed. But the law as it stands today, it does not envisage that such situation could get covered. Now, there are two cases which real estate cases. I think I would just like to leave it for your consideration, but I will share the facts of this case. Very interesting case, and we thought that we must consider this. Sorry, before that, I think Sanjay ji had asked me the question whether we are touching about the valuation aspect. I think it is very important for us to consider the provisions of this section 50C versus section fair market value. If we see 9(b) in section 45(4), there is a clear wording says that it has to be the fair market value of the asset. It nowhere refers to section 50C, nowhere refers to 43(6), 43, where we talks about stock in trade. That value sections are not been referred to. So therefore, if we consider that aspect, in my view, fair market value has been separately defined in the Act. So therefore, we'll have to go by the definition of fair market value and cannot go to section 50C or section 43 for the purpose of stock in trade valuation or a 50C valuation, which talks of a circle rate or ready reckoner rate, which is permissible for 50C for the purpose of section 9(b) or section 45(4). My personal view is when we are considering 9(b) and 45(4), we'll have to strictly go by fair market value and definition of fair market value as given in the Income Tax Act. And Income Tax Act has specifically given a definition under the section 2 itself, and that will govern that decision. Now, before I come to the Mansukh Dain's case, quickly I'll just touch upon two aspects, and then we'll leave a floor open for the questions, because I believe that a lot of questions have already come in, so we'll just touch upon them. One question is, now typical case, and this is very common, which is what is noticed in the real estate industry, real estate building cases. There are four partners, A and B and C and D. Suppose in this case, C and D wants to retire. He is retired from the, say, 31st March 23. He is paid capital account balance, so there is no gain because he has been paid they have been paid exactly the same balance. But it is agreed that firm will develop the property, and after the development is complete, which will happen in after 3 years or 4 years, they will be paid the amount, they will be paid constructed area in the same ratio in which they were partners. Now look at the situation. Partner has retired in March 23. He is not getting anything today, but he is getting after the construction is completed, which is after the few years. Now, if he is going to get a constructed area, which section will apply? Will it be 9B or section 45(4)? That's the first question. Number two, if 9B is to be applied, what is the value to be considered? Now, if we see that if the firm is developing the property, firm will distribute them at a value which is already cost to them. So therefore, there is, even though there is a distribution in 3rd year's time, it will be same values. There is no difference in the market value and the book value. So therefore, it will remain to be the same. Third aspect is partner is retired in 23 and consideration is received in 25-26. Will it be treated as in connection with the retirement these people are getting? In my personal view, if there is a agreement or retirement, it clearly says in consideration of partner retiring, they will get 45% of the constructed area as and when constructed. Then provisions of section 9B will definitely trigger because it is a stock in trade distribution, not 45(4). 9B will trigger and then this will be applicable. So therefore, this is important. But it will fail, charge will fail because there is no difference in the market value and the book value of the stock in trade. Therefore, no taxability. So again, on the end of the example, we'll find that there is no taxability at all and only 9B will trigger and no tax will be there. One more small point I think we should keep in mind. Everywhere it says consideration to be paid by a specified entity. But if specified entity doesn't pay, but incoming partners pay directly outside the books to them, not through the partnership form, but pay directly to the retiring partners, will the provisions trigger? In my view, since it is a consideration paid since it's a consideration for the purpose of retirement, whether it is paid from the firm, whether entries are passed in books of accounts or not, it will not be relevant and it will be taxable in the hands of the firm under either 45(4), as per 45(4), provisions will trigger in this case. So therefore, my view is irrespective of whether money is come in firm and firm has paid to the retiring partners or retiring incoming partners directly paid to retiring partners will really not have consequences. One more interesting point I would like to leave it for your thought for consideration, because many times there is a dichotomy as to whether section 56(2)(10) will trigger vis-a-vis the transactions of 9B and 45(4). Because there could be some difference in the valuation at which assets have been distributed and what is the market value of the asset as per 56(2)(10). As I mentioned, the valuation which is there for 9B and 45(4) is in fair market value. But when it comes to 56(2)(10), it talks about ready reckoner value or circle rate. So there could be always a difference between the fair market value and circle rate. As we are familiar with the real estate industry, as of today, the actual market value of the properties is much less than the circle rate. So therefore, what will happen? Will 56(2)(10) get triggered? That's the point I think we'll have to consider at every case. Another point which we should consider is, can we say 56(2)(10) will trigger at all? Because 56(2)(10) can trigger only when it is a transaction without a consideration or not sufficient consideration. The transaction which is already subject to 9B or 45(4), can that be a transaction re-examined again for the valuation purpose under section 56(2)? As Sanjay ji was referring to valuation part, it will come trigger here in 56(2)(10). In my view, first of all, transaction which is examined and considered taxability or otherwise in 45(4) or 9B cannot be re-examined under 56(2)(10), number one. Number two, if we are to examine 56(2)(10) applicability, we'll have to see whether it is a specified asset in that section. Right title interest in the firm is not a specified asset in 56(2)(10). So again, on that count, this provision will not apply and this will not come in the picture. The last 2 minutes, I will just take it to deal with the Mansukh dying. Piyush, 2 minutes is fine. No?
Yes, sir. Yes, sir. Please go ahead.
Okay. Just want to cover the Supreme Court decision. As we have seen, the amendments have come in with effect from 1/4/20 and assessment year 21-22. But the matter before Supreme Court, what was there was from the assessment year 92-93, which came in the which came in before the Supreme Court in the year 22. And Supreme Court in 2022 has held, approved the ratio laid down by A.N. Naik's case and said that even in case of a retirement of a partner, if the assets are distributed, it will be a chargeable tax. If we have to really consider the correctness of this decision, I think all of us need to see the facts. In my personal view, we do respect whatever we say. We do respect that decision really does not lay down the correct principle law. In fact, correct principle of law is really laid down by the Supreme Court in earlier decisions. Mohan Bhai Pamma is the correct decision, and that still holds the good. So therefore, the view which is taken in this case, Mansukh dying, according to me, is really not the correct view. But as we said, this decision is really applicable only in respect of old cases which are pending at the different judicial forum under the old law. But whatever it is our duty to ensure that if similar facts, similar cases come in for assessment year, earlier assessment years, 2021 or earlier years, we need to consider and see that facts were peculiar in Mansukh dying case, which may not be the normally facts in other cases. Therefore, keeping that in mind, we need to distinguish the ratio laid down in Mansukh dying for the earlier cases. Friends, these are some of the points for which I wanted to share my thoughts and understand from all of you, because this is again more academic exercise for me. I don't deal with the day-to-day on this similar type of cases, but I thought it's good to, because when Piyush asked me, I said I can consider a topic which I have not studied earlier. So my colleagues who did excellent effort and got this to at least brief me what the provisions are. So I said, if you have appreciated the points considered, you have to thank my colleagues, Lake, who is sitting with me and helping me in technology as well as preparation. And he has helped me to prepare all this. So Lake Mehta, who is also our colleagues in the office, so he has helped me to prepare this. So we should thank him. So with that, I will hand it over back to Jayesh. So consider any questions which are not covered or which are relevant or which are of general importance we can cover. Otherwise, this is at least you will have to guide me as to questions. Otherwise, we'll have to refer to Piyush and you to reply to the questions if I can't.
Okay. Thank you, Senior Rajan Voraji. Vora sir, can you? Okay, sir, please do this. Stop the screen sharing. Okay. Yeah. Okay. Really outstanding, sir. The way you have touched upon this amendment. But before we move towards the Q&A sessions, since our Vice Chairman Directors Committee is here, Piyush Shahjed, our Central Council member, is with us. So we propose our hearty welcome, also warm welcome to you, Piyush Bhai. Thank you very much for this session. And with the permission of Speaker Sir and you, whether first we should move towards the Q&A sessions and then you can add on this particular topic, or first you want to add on this?
No, sir. First go with questions and answers.
Okay. Sir.
Piyush, I was just explaining to everybody. I said my relations go back with the SP Shahjed sir, and when Piyush used to accompany him. So I said I have learned a lot from SP Shahjed sir, because every day we used to meet in the tribunal, and I think a lot of good points you all learned from your father.
Thank you, sir. Sir, we are learning from you, sir, day in, day out. When you argue, sir, we see. Sir, we have been learning, seeing you, sir, every day, sir.
Yeah. Jayesh, you can take the questions.
Yes, sir. So looking at the number of participants and the interest shown by the members, so really speaking, it was a great topic you have selected, and thank you, Piyush Bhai, for this wonderful session. So now the questions what the member have raised, I will just take it as per the available time limit, and we'll try to cover most of the questions. So first questions, it is whether it is applicable to the professional firms, LLP, and also whether the limited liability partnership firm covers. This is the questions they have asked by one of the members.
So, as all of us are aware, business includes profession or vocation. So, therefore, professional firms also will get covered. So, there is no dispute about it. 9B and 45(4), because professional firms also could have capital assets which will get distributed, or even retiring professional firms partners will get something extra consideration, which also will get taxable under 45(4). So, therefore, the short question is, professional firms will also be subject to 9B and 45(4).
And they've just the member has asked regarding the LLP also. So whether it is applicable to LLP also.
Yeah, because for LLP for income tax purpose is a firm.
So it is.
So it is assessed as a firm,
Yes.
even though it's under the Companies Act, it is a LLP, limited liability partnership, but it is the income tax is treated this as a part of the firm. Therefore, if you see the definitions of all these amendments are relating to all the three. That's why I said initially only I said who are the specified entities covers LLP, partnership firms, AOP and BOI. So they're all four are covered.
Right, correct. So another questions, what the treatment if the reconstitution takes place of the firm and the transfer their property at the same value as recorded in the books without charging more or less than the FMV?
So as you rightly said, we have to examine two sections, because if it is a capital asset distribution, 9B as well as 45.4. If strictly we have to answer under 45.4, and the example what we see, it may not be taxable at all. But if it is a reconstitution where the profit sharing ratios are affected, then provisions will get triggered. That is part one. Part two is if it is a 9B, if it is triggers the 9B, it will automatically get again trigger the provisions. Yes, it is applicable, and therefore we have to see the difference in the market value and book value of the asset. There is no question of capital balance, because as we discussed in detail, 9B refers to excess amount realized or excess value deemed to have been realized by the firm, and that becomes taxable. There is no question of what is excess by partner. In the example, Jayesh, what we saw, in one of the examples, his balance was 10,000 rupees, but he got 9,000 rupees worth of asset, but still he will become taxable because value of the asset received is more than the book value of assets. So therefore, that is the criteria we need to consider.
Right, sir, rightly said. So another question, let's move towards another question. Whether any consideration in cash over and above the amount credited to the partner's capital in the current account received by the partners on the retirement can be taken as a long-term in nature, being a partner since more than 3 years, and if so, then whether section 54F can also be considered.
Yeah, so I think, sorry, with the want of time, I could not examine the detail. The question is, it is a taxability of the income of a partner, but taxability in the hands of firm. So therefore, it is not the income of a partner, because the moment it becomes a taxability in the hands of firm, partner is not liable under 10(2)(a), because income becomes income of a firm. So therefore, it is not taxable in the hands of partner. If it is not taxable in the hands of partner, then the question of claiming 54 and 54F exemptions does not arise, because it is not taxability. Income doesn't add in his income computation as a capital gain at all. But incidentally, if there is a 54 EC firm wants to claim, I think that is possible, because that's a deduction available to the firm entity. So whether they can claim exemption, yes, they can claim exemption. But partner, what he can claim exemption? That, take an example further. Suppose partner has a capital loss. Can he claim a set off? Firm can claim a set off? No. Firm will be chargeable independently on that income alone. Partner has a carry forward losses or set off of losses that cannot be brought to the firm for taxation purpose. So therefore, that's a clear provision which we need to understand. Though computation mechanism is for the taxability of partner, what he gets excess, but does not, which is tax is levied and recovered from the firm. That's the important point to be considered.
Right, sir. So another question. It is there are only two NRI partners in a firm, husband and the wife. The firm owes the IMOL property. Husband dies in the mid of the year, and whether any income tax liability in this case in the hands of the firm or the partner.
Can you just repeat the question, Jayesh?
The question is, sir, there are two NRI partners in the firm.
NRI partners.
NRI partner. Husband and the wife.
Okay.
The firm owns the IMOL property. Husband dies in mid of the year. So whether any income tax liability in this case in the hands of either on the hands of the firm or in the hands of the partner remaining.
No, I think it's a very good question. There are two aspects which you need to consider. Since they are NRIs, we need to consider taxability under the treaty also. So we need to examine under the which country's treaty is applicable. Suppose they are from the Netherlands. Netherlands treaty will be different than the treaty with UK or USA. So therefore, if it is the Netherlands, Singapore, or any other country, we'll have to examine that treaty first when we are considering the taxability of NRI in the form, because they are the non-resident partners. That is part one. Part two, which we have to consider, is when there is only two partners and one partner dies, does it amount to dissolution or is it amounts to a reconstitution? So as I was explaining, I hold the view there is neither distribution nor a reconstitution when the person dies and firm is succeeded by the remaining partners. Is it anything extra paid to them or any realization of assets has happened? So neither there is a realization nor there is a distribution of any assets in the hands of partner. So again, every time as a touchstone is we have to examine whether there is any specified person, whether it is a specified entity, and whether it is the distribution of cash or capital asset. In this case, and I again hold the view, in case of payments, even if payment is made to the legal heir of a deceased partner, it will not get triggered here. But leave apart that controversy. But even if on the other two aspects, according to me, this will not be taxable, and we can take a help of old Madras High Court and Kerala High Court decision, which have said when there is a dissolution on account of a death of some partner, it is a really succession and not a distribution. So therefore, that could be considered. So as we discussed, we need to see the treaty of the respective country. That is part one. Part two, we need to consider whether there is any distribution or reconstitution. Yes, there is definitely reconstitution, but is there any distribution? And if there is no distribution, only succession happens, will it be chargeable tax? According to me, is a good case to argue that is not taxable.
Right. So another questions to some extent we have answered, but let me take that question. So if the firm is dissolved on, say, let's say 30th June 2022, and the assets were stock in trade and the movable depreciable assets, the partners sharing ratio was 6:4, 60/40. All the assets and liabilities were taken over one LLP newly formed. How to arrive at the income of the firm in a particular section 45(4) and 9B, and how to show the cost of the above assets in the LLP.
So question is, first of all, if we take a view that dissolution or succession by the LLP is triggering the taxability, if we take that view, it is taxable, then we'll have to go by saying that assets are distributed to the successor partner, that is the LLP, and earlier partners have been paid off by the LLP, then question of taxability will come in. And question of taxability will come in on the difference between market value and book value. So question is, so really highly debated, highly arguable case. My personal view is, if it is a succession and exempt under the Act, taxability should not arise. Like 4713 or 4713 is applies. Will it be taxable or not taxable? According to me, it's a good case to argue it is not a distribution. It is succession. As we said, Madras, and we have favorable decisions of Madras and Kerala High Court.
Right.
But again, fact specific, we need to understand the facts a little better before we really answer. As jokingly always been said, corridor opinions are not the proper opinions. It is only for the discussion purpose, not for the taking any decision on that basis.
Yes.
Right.
Okay. Another question, sir. A private limited company was converted into LLP, and the shares premium is lying in the LLP. What will be the treatment of the share premium if any one partner retires from the LLP?
So, company is already converted into LLP, correct?
Yes. Yes. So
that part is over. So that is not a trigger point here.
Yes.
That stage is not considered. That is not applicable under 9B or 45(4). That is part one. We have to really see, is there any, after it becomes LLP, is there any distribution on the retirement by any of the partner from that LLP? If there is any distribution or retirement by the partner, then the provisions will trigger. If there is any distribution or any amount being given to them, distribution of capital asset or amount being given to them. So therefore, need to be sure we are considering the taxability of the conversion factor or a factor of LLP. If there is no change in the LLP constitution, then the question of taxability may not arise.
Right. Okay, another question, sir. What happens if there is a complete dissolution of the firm?
And partners take the assets and net amounts has been paid.
Yeah, definitely.
Yeah. So if we take the view that there is no succession but distribution, then 45(4) and 9(b) both will trigger.
Yes.
Because assets are realized, amounts have been paid to the partners, and some assets may be taken physically by the partners, outgoing partners, or swell partners. Then 9(b) and if it's stock in trade, 9(b) will trigger. If there's a capital asset or cash distribution, 45(4) will trigger. And there will be some extent double taxation under 9(b) and 45(4), subject to the credit available for under 48(3), 48 Roman 3.
Right. Okay, so can the surplus amount paid to the partners at the time of the retirement can be claimed as an expense in future?
No, so I think provisions are very clear. Whatever taxability, except in case of a capital asset distribution, that is not allowed to be spread over the other assets. There is a specific provision permissible only under as per the specific provision of the Act. Only when the 9(b) and 45(4) gets triggered, there is a distribution of capital asset, then that surplus of the capital asset is spread over the remaining capital assets. But except that, nothing will be allowed as a deduction in the hands of partner. Let's take example. Suppose there is a running partnership firm. Out of 3 partners, 2 partners continue and 1 partner retires. And he's been paid extra amount. Let's take a situation, he paid extra amount. Can that extra amount be treated as expenditure in the hands of firm? According to me, no. Only if it is a distribution of capital asset and the firm has paid tax on that, then that excess amount, that what is paid, is allowed to be spread over the other costs to avoid multiple taxation. Because today you are paid 9(b), you are paid 45(4). The third time when the firm sells those remaining assets, there should not be tax. Therefore, that is a precaution which has been prescribed, but not the situation what we are discussing. Therefore, it will be clearly applicable.
Sir, I'll just add it to this question, sir.
Yes.
With your permission, Jayesh bhai. Sir, my capital balance is 100 rupees and the firm has paid 200 rupees on the reconstitution. So this 100 rupees will be debited to what account? If it is, as you rightly said, it cannot be claimed as a deductible expenditure. Correct. Then what will happen to this 100 rupees?
No, normally what earlier under accounting, our Watlub and Shukla Grewal, as we remember old act provision, it has to be debited to the partners' accounts. It has to be debited to the other partners' accounts. Because it is really paid by the firm, but it has to be debited to the partners. It is not something asset of the firm.
Can I debit this to goodwill and then claim it later on when again I am transferring it to somebody else and I receive that amount? Yes. If firm receives in future further amount, let's say remaining partners,
but
they instead of 200 receive 400. Whether they can adjust this even because it's goodwill. So can I adjust that?
No, so you're right. No, you are right. Absolutely. So there are 2 aspects. Whether this excess amount paid, could it be called goodwill? That's the first point. Or is it the overall valuation of his interest in the firm for which we paid extra? If it is paid for the valuation of his right title interest in the firm, then accounting can be made, as what you rightly said, goodwill or intangible asset, that can be made. Point is, will we be allowed a deduction? Specifically, section says no. You can't get for any self-generated assets, you can't claim a deduction. So therefore, deduction will not be allowed. You can treat either reduce from capital or continue to hold it as a different forms of asset. There is no problem. That's not the issue. Yes, net worth, as you rightly said, Piyush, the net worth could be improved. If you, instead of reducing capital, if it is shown as asset, net worth will be better in the firm's books.
Right.
Right.
Yeah, Jayesh.
Okay, so only 2-3 questions are left. So the next question is, sir, what will be the situation if one partner gives his share to any of his relative?
Subject to 56, there is no problem. 45(4) can't come in. 9(b) can't come in. is a
Right.
is a really gift of asset which sub 56 will trigger. If relative falls in the definition of exempted category, then there's no problem.
Right.
And again, subject to controversy, I said, whether the right title interest is really specified asset under 56 first.
Right.
If it is specified assets, will it be taxable or no? So according to me, good case, no. Nothing will be taxable. And gift of right title interest is not coming under transfer. Because there is neither money received nor asset distributed. Right title interest which I had transferred, gifted to somebody.
Okay.
This is without consideration.
Right.
Because 47.3 specifically says anything without consideration is not chargeable to capital gains.
Next question, sir. If a reconstitution if takes place at the mid of the year, so let's say 31st of October, do we have to compute the restated capital balance post-tax or just transfer the profit up to the date of reconstitution?
No, but this is for what purpose will be? Accounting wise, yes. Many firms do that. They make the provision for taxation up to that date to adjust the correct capital balances. That happens. But for taxation wise, it will not make a difference whether you debit or not debit to, or make a provision of taxes up to October. It is more accounting or our partners' inter se accounts. Partners' inter se could be useful, but not for the taxation purpose. It will not make a difference.
Sir, I believe because my capital account balance changes on the date of distribution. So if any money has been distributed, it includes 6 months capital balance post-tax. So my tax liability under 9B may be different. Maybe that may be the curious.
I agree with you. Later on, suppose there is a reconstitution, if some amount is going to come to me, yes, it will make a difference. I agree with you.
That's it.
Profit balance will go up. You are right, Piyush.
Right, sir. Thank you, sir. Yes, Judge.
Okay, sir, we'll now take the last questions probably. Sir, in the case of the death of the one of the partner, another partner, as per his will of the deceased partner, is induced, and the capital of the deceased partner is credited to the legal heir, who is given the same ratio as the deceased partner had. So whether such case, the 99B or the 45(4) gets triggered, as there is both the stock in the trade and the capital assets held by the firm.
As I said, if partnership deed prescribes that in case of a death of a person, legal heirs will automatically step in his position and everything remains same. According to me, there is neither distribution nor reconstitution. There is a reconstitution, but not distribution. Neither cash nor capital asset.
Yes. So these were the questions from my side, and thank you very much.
I'll take one question. I don't know whether
we all are eagerly waiting for you, sir. So,
sir, I have one question for Rajan bhai. Of course, I could not join initially because I was on trouble from Delhi. I don't know whether it was covered in issue, sir. Sir, if the reconstitution takes place in one particular financial year, but the amounts or the capital asset is received by the partner in another year. Now it talks of reconstitution and receipt. So what will be the trigger point for taxation? Whether when both completes, then the tax will apply, or reconstitution ke time pe lag jayega, or it would be at the time when receipt is important. What could be the
very right, Piyush. I think we discussed these issues with various examples we discussed, because as you rightly said, there are the conditions are receipt of amount by partner and reconstitution, and amount has to be paid from the specified entity to specified person. As you rightly put it in example, partner retires in the first year, amount received in the next year, when he is not a specified person. So taxability will be in the first year, or taxability will be second year. Because that is going to be highly debated. That's why I said, if we want to be fair to the government, we should recommend to the government, which I was telling to our chairman, Sanjay Kumarji, that we need to recommend them that there is a flaw in the provisions, and therefore you need to rectify this flaw. If you don't rectify, after 10 years, you will realize that we have lost up to Supreme Court. Therefore, we need to amend the law. So therefore, if need to avoid litigation at a later stage, it is better to come. The loopholes which are there, I would call loopholes or drafting faults are there, need to be rectified right now.
Right, sir. Right.
No, you are very right. There is going to be highly, at least I have covered at least 6 case studies exactly on the same point, different years.
Okay.
Different years.
Okay.
persons are not there, persons dies. So all those, or conversion and successor entity pays to the partners of erstwhile entity. Then what happens? Suppose successor is a limited company, and limited company is going to pay to the erstwhile partner after 2 years or 3 years or 4 years down the line. Then what happens? Because there is neither a specified person nor specified entity, and again receipt of money. So, and we also took example, Piyush, case to transactions which happened in before 31st March 20. And now money is paid in 21. Which provision will apply? Old provision or new provision?
New provision, right.
So according to me, new provision can't apply because transaction, I mean, the retirement has happened in the last year, which is under old
Right.
provision.
Right, sir.
So merely because the event of payment is happened in current year, it can't be, new provision can't be invoked for that provision.
Sir, I will look into the recordings for all these examples, sir.
No, I think there are some
wanted-
points we must recommend to the government to rectify at right time.
Definitely.
So that at least we don't get the Vodafone type of things after 20 years.
Yes, sir. Yes, sir. Agreed, sir. Sir, thank you very much, everybody. Good evening, everyone. Thank you very much, Rajan Bhai, for accepting our invitation from your busy schedule. Rajan Bhai is obviously, you have listened to his biodata also. He has been quite busy. I see him often arguing in the tax tribunal. I'm appearing before tax tribunal since last 14 years, 15 years. And whenever Rajan Bhai is arguing, I try to be in that courtroom and try to listen to him. At least by even listening to him, you can actually be equipped and you get a confidence that you can appear before ITT. That's the wonder of Rajan Bhai. Of course, I'm singing from my childhood days itself. Rajan Bhai, thank you very much. And especially covering the topic 45.4 and 9b. It's a very difficult topic. Obviously, it has come to this statute now. It's almost 15 months. But still, there are so many issues. And as rightly pointed out by you, I will, of course, look into your recordings and issues raised by you. And at DTC, we try to take it up with the CBDT also. So if they can come out with the amendment in the law or the clarification or some sort of, so that the litigations can be avoided, that would be an idea. But this difficult topic to be covered in such a lucid manner was really great to you. Thank you very much, Rajan Bhai. Thank you very much. Jayesh Bhai, thank you very much for coming in, joining in and moderating and raising wonderful questions. I'm sure there are so many questions would be coming up. And then summing up into a 6 or 7 or 8 important question itself is also very difficult because I've done moderation. And sir, you will, just for your information, we had a total audience of 2244, which I last saw. There were 2,244 people who had logged in for viewing this webinar. And that too, after we released the flyer only 2 days before. I'm sure if it would have been released a week before, then this would have been double the time because the stature of the speakers fixed for that. So thank you very much once again, Rajan Bhai. Thank you very much, Jayesh Bhai, for time, for moderating it well and being available for DTC. We will again look forward to your contribution wherever required, Rajan Bhai. I look forward to it.
My pleasure, and thank you very much for this opportunity to the chairman, sir, you and all speakers, sir, and all.
Thank you, and have a very good evening.
Piyush, only one suggestion. Whatever they want to issue, they should make amendment in the act itself, because more clarification, more confusion happens.
More clarification. I appreciate, sir. It should come through act only.
Absolutely.
I agree, sir. Thank you very much, all the participants, for your patience. Keep joining, keep watching our websites. We keep on coming with such fortnightly webinars with a very big, good speakers who are known in whole of India and who are known globally also for their topics. Thank you very much. Thank you, everyone. Tag team, Prachi, we can stop the recording and end the session.
Thank you for opportunity for refreshing my knowledge.
Thank you.
Sir. Thank you, sir.